Hello, everyone. Welcome again to the Wealth Preservation Podcast. We're joined again by Eli Weiner. How's it going, Eli?
Very good. Thanks
Good.
for having me again.
Yeah, we're excited to have you on. So if you didn't catch Eli on the previous podcast, we talked a lot about just Eli's entrepreneurial story, how he grew Boa Vida to about 100. He's about 100 employees now, and they're kicking some serious butt in the very niche space of mobile home parks and RV parks, which is very cool.
Yeah, well, by the end of the year, we should have right around 100 mobile home and RV parks owned and operated.
Wow, that is amazing. That's a lot of real estate to manage.
And a little backstory as to how we got introduced. Josh and I used to work really closely in the asset protection business, and a lot of the clients were looking for a tax bang that matched with their asset protection. We kept telling them, like, asset protection and tax strategies are completely separate. You do not, you have to do them separately. And one of our clients actually came to us saying, hey, you guys did great on the asset protection side. I found a killer tax strategy, and I think you guys need to meet this guy.
Absolutely. And
he set up the first meeting, and it has been pretty eye-opening as to what you guys do.
Yeah. So we're gonna kind of we'll kind of touch on just briefly kind of the previous podcast stuff. We'll kind of talk about what how you invest in mobile home parks, and we'll really talk about the tax portion of it because that's been a huge piece as of lately, as you've said. And then we'll kind of cover some stuff at the end. So we'll go ahead and kick this off. So let's real quick talk about give a brief. How did you get into the mobile home space, and then why have you stayed so focused in the mobile home space?
Yeah, so we've been focused on mobile home and RV parks for the last 18 years.
Okay.
And as I mentioned before, every time I looked into doing investing outside the mobile home park or RV park space at these different businesses in real estate,
Sure,
office, warehouse, mini storage, I just couldn't I couldn't come up with as predictable cash flows and the safety that I had with mobile home parks.
Yeah.
So they've always been just fantastic investments for me and our investors. So we've continued to grow the company. But what we found this year is that all of the majority of the interest this year, and maybe it's because everyone's making a lot more money.
Right.
And we want to make sure that we have that money protected.
Right.
So the focus has been a lot more on the depreciation side and the tax protection side. And when I think about mobile home parks, a lot of people are doing, if they're in a 1031 exchange and then they go into like this triple net and they're stuck in this thing that maybe they think it's safe, but it's a single tenant,
right?
And they're buying it already at a low cap rate and trying to predict, or they have like a long-term lease that has very minimal increases, and if they ever lose that tenant, they're in a lot of trouble.
Sure.
And the tenant improvements if would also like destroy their returns. And so you look at things that are supposed to be safe, but they don't have any tax protection.
Right.
They don't on that cash flow. They don't, and they don't have any significant upside.
Yeah.
So when I think about these mobile home parks, well, the predictability. I mean, one single mobile home park, if it's 100 spaces, you're diversified in 100 different ways. If one home burns down, you still have 99 there. If two people move out, you still have 98, paying you rent. So you're very diversified in many different ways just with one park. So now, we put together this fund that we're investing all over the country in fantastic markets, and we're able to, get, start out, with cap rates between, 4.5% to 9%,
wow.
right out of the gate.
Yeah. And
all these properties have, they have tax protection. They've got, solid, cash flow. But the other cool thing that they actually have is upside.
Right.
And I think that, a lot of our investors, they're selling their companies and they work their butts off when they sold their company. Like they built these companies, they have tons of employees, very people intensive. And then they're trying to figure out, okay, well, I've got this tax problem, and also I have, I'm sitting on this cash, and what do I do? Well, for me, the mobile home parks are kind of the end game because they're, it's the predictable cash flow. They have the tax protection, and on top of that, they have upside.
Right.
And that's, I think, the real key, because I think when people become wealthy, their whole mentality is, how do I protect my capital, right? Because and when you look at these guys' wealth, That's why there's all these hurdles that people have. Even like someone that's worth 300 million, they make to 300 million, then they stop there.
Right.
Because what happens is they start diversifying all over the place, and they don't focus on any one thing.
Right.
And it's all about them not losing money, not
Right.
them making money.
Right. Absolutely.
So, but if you can put it in a safe spot that gives you more money back, so you can continue to compound it, that has that tax protection, and then on top of that, it actually has upside.
Yeah.
So
let's kind of get, and can we kind of get into like a deal structure kind of, and why you went into the fund route, and kind of what does that look like, just, and obviously you can use generic numbers or you don't have to be specific, but what does that deal structure kind of look like, and how does that work?
Let's break it down to one specific deal.
Yeah.
So if we got a $10 million park, we're going to buy that park, and it might produce, we're going to buy a $10 million park with the goal in the next 5 years of increasing the value of that park to a $15 million park.
Okay. And that's done through rent increases and other
That's
capital
done
improvements
through
and things like that.
passing through the utilities.
Okay.
Making sure that just, all of us pay our utilities, but a lot of these mobile home parks, they don't pay for trash, they don't pay for water, so we got to install water meters, so we put some money up front, install the water. So we pass through the utilities, reduce the expenses. A lot of times there's vacant spaces. So we'll bring homes in, get them set up, sell the homes, and then fill up those spaces.
Okay.
A lot of times there's infrastructure. So there's tree work, there's road work. We go through and knock these things out.
Yeah.
We focus on the entrance. We focus on the office.
Okay.
Presentation's important to me. So once that's done, and then you have 5 years of, rent increases, and you get to that new value, and you can predict the value because everything's based on cash flow.
Yep.
I'm not worried really about what the economy is going to do. I'm not worried about what interest rates are going to do. When I'm projecting my interest rates, I'm projecting like 6.5% interest rates in 5 years from now. I'm projecting higher cap rates.
Right.
So I'm doing all that stuff to be on the conservative side. I'm still making my 15 million valuation, and the goal is always beat these performance. So what we do is we refinance. So when you go and you solve all the problems on this company, and if you think about these guys that they sold their companies, if they could put it on autopilot after they sold their company, maybe, and the cash flow was killer, then they would just keep it. Right. That's not really the case, right? They're trying to, buy themselves more time, and that's really what a stabilized mobile home park does.
Okay.
You have this passive income. You've got the mailbox money. So
right.
And that's what you want because we all have limited time.
Right.
So how do we buy ourselves more time, right? And they always say, well, you can't buy yourself more time. Well, bullshit to that.
Yeah.
You can absolutely buy yourself more time by getting passive income.
Sure.
Because your time is already taken, right? The whole thing's already taken.
Yeah.
And there's a big portion of you working for it.
Right.
So if you just take out, every time you add an extra $1,000 a month that you don't have to, you do anything for, and it just shows up, then boom, boom, boom.
Right.
You're just adding all that extra life.
Right.
Yeah.
All that extra freedom.
Sure.
So, so what we want to do is we want to stabilize a park, refinance it, get a new loan at $10 million.
Okay.
Get all the investors their money back.
Gotcha.
And then they continue to hold their ownership forever.
Gotcha.
And that asset just performs and it continues to grow.
Yeah.
And then the investor usually turns around and says, okay, well, you just gave me my money back. What are we going to do? Let's go do another one. So because, the problem kind of created itself, right? We did a good job.
Right.
And, my money came out, their money came out, and it was, okay, let's go do it again.
Good problem to have, by the way. Yeah.
Yeah. So a lot of real estate syndicators, what they do when they get to kind of our size is they could just go start cherry picking.
Okay.
And they'll go do their own deals. And then they'll say, thank you, investor. We're moving on. I didn't want to do that.
Gotcha.
That was boring to me.
Yeah.
And it wasn't really the loyal way to do it because they were there when I didn't have any money.
Right.
I didn't have any family or friends that would,
Yeah. With the 3 F's, right? Friends, family, and fools. Those are the three people that invested in your
they
startup.
didn't give me any money, right? I had one cousin actually that still invested Dane Weiner, phenomenal guy, killer attorney here in Sacramento. And he invested early on used a credit card.
Okay.
And he still invests.
Yeah.
And he's done phenomenal.
He's used 2 credit cards now.
Yeah. Doesn't need to use a credit card anymore to invest. But that was 18, 19 years ago.
Right.
That was funny though. That was good. So now, So the fund just is the investor for all those deals. So we all put our money into the fund, and then that's the investment vehicle. There's nothing, no waterfalls or anything that happen there. That invests down into the park level, and then at the park level, that's where all the money flows up to the investor. And
so let's kind of talk about that $10 million deal structure, right? So when you initially go in, what are you going in? Capital requirements and things like that, loans and that kind of stuff. So how's that work?
So we typically get like a 30 to 35% loan.
Okay.
So in that scenario, let's say we put $3.5 million down. We buy the park. Sometimes if we have to, if we're competing with other people, we have to go close it all cash.
Okay.
And then we'll get the loan after.
Gotcha.
But let's say we put $3.5 million down. We have a $6.5 million loan. Let's assume it's a non-recourse loan, and it's not always. Sometimes we'll buy some uglier stuff, some 1.5 star stuff that we may need to make a 2.5 star park. Right? If we buy a 3.5 star park, let's turn it into a 4-star park. Let's improve on it. So, but in this $10 million case, it's a non-recourse loan. So here's how the depreciation piece works.
Okay.
We typically take about 20%. And it depends on the location and stuff like that. But we typically, it's probably averages around 20%, and that's going to be land.
Okay.
So you'll carve that out, and that's land. You can't depreciate
So
land.
just on some rough numbers, if you're a $10 million deal, $2 million of it's just the land.
Right.
$10 million size. Okay, good.
So then you have the office building, the clubhouse, the laundry room. That's going to be 39-year depreciation. So you take that. Maybe it's only... 300 call it $400,000. Right. So you're going to take that $400,000, you're going to divide that in 39 years. That's the depreciation you get. And then you have maybe a park owned home that the manager lives in, or it's a mobile home that the
Sure.
So that's residential. So it's 27.5-year depreciation. So we're going to take that and divide it in 27.5 years. So let's call that $100,000
Sure.
of value.
Yeah, it's for easy math. Yeah.
So now we're down to $7.5 million.
Yeah.
So the investor put down $3.5 million and got a $6.5 million loan. You have $7.5 million left of, we call that infrastructure.
Yeah.
And that's going to be depreciated normally in 15 years. Yep. But what happened in 2017, the tax law changed, and you can take all 20-year or less depreciation in one single year. Okay. In that same year. And take it as bonus depreciation.
Wow. Okay.
Yeah. So what happens? You in 2019, when you go do your K1s, you have a $3.5 million investment. You have a $7.5 million loss. So that's that's pretty huge. That's pretty killer. So if you have these investors that have a bunch of passive income, and they've got all this passive income that's not protected, right? And they're sitting there paying 30-40% to Uncle Sam, right? Then when they invest in mobile home RV parks, right off the bat, they can offset all that.
All that tax. So just real quick, what we're giving here is not tax advice. If you want to know more, you can contact Eli directly, and also please talk to your CPA. But this is a really awesome. No, this is an amazing strategy, and really using that new tax law change to really harvest a whole bunch of that accelerated depreciation on that park.
And I think one of the very unique things about it is, a lot of times people ask like, hey, how can I push this tax down the road? And everyone's just trying to kick things down the road. And with this strategy, it's, hey, we're actually going to go ahead and we're not going to kick it down the road. We're going to claim it, but we're going to do something else that's going to offset it. And it's really about the timing of it, to where it's like you're actually claiming it and getting that burden off.
Yeah, you're losing the tax liability.
You're losing the tax liability because we're going to go do something else that's super unique, and we're going to kind of offset that.
Yeah.
Yeah, this has been kind of an amazing thing for people that have a lot of passive income, just to work their passive losses against their passive gains. But the other way people have been investing is instead of doing a 1031 exchange. So right now the market's tough. Right. I mean, you have to have. I mean, I've got a team of really fantastic people out there looking for deals, and we look at thousands of deals. Right. So, and we're passing on deals all the time. Right. And if you're just the normal investor and you've got a 1031, trying to find a good deal is very tough. Right. Yeah. So these guys, they get stuck and their 45 days is up. They can't do anything. So we've been able to help investors. They plug into our investment.
Yep.
And what happens is the federal loss on the from the depreciation
Right.
offsets their federal gain.
Mm-hmm.
So it doesn't help with their state. They're still stuck with their state.
Right.
Yeah.
But it's offsetting their federal gain. So they don't even have to do a 1031, and it's been kind of a little bit of a game changer.
Oh yeah, absolutely. I mean, so you're basically wiping out your capital gains tax, taking that money now, and now you're not back in the 1031 game, which is roll because you're going to pay the tax at some point. You just wipe it out. And it's done.
Some guys, depending on their passive income, it's like they're investing at half price.
Right.
Uh-huh.
And the crazy thing for me is, even without it's you're investing in mobile home parks, so even without this whole tax benefit, to me, it's like, what else? I struggle to figure out what else to put my money into.
Yeah.
Right. No, absolutely. Right. Yeah, absolutely. I don't blame you.
Well, and to put some real numbers, into it, like let's say, I'm an investor and I'm like, hey, I have this $750,000, tax bill that's going to come due. I just sold a massively successful company. Like, how much can people expect to depreciate on their first initial investment?
So we used a non-recourse scenario.
Uh-huh.
So with a non-recourse scenario, it goes to the operating agreement. Operating agreement says that all the investors get 100% of the depreciation as long as they can use it. So in that scenario, of the $3.5 million scenario, they would get the full $7.5 million
So they get
of
the full
depreciation.
$7.5 million.
Yeah.
Yeah.
Wow.
So that's just going to follow the money flow right up to them. If it's a recourse loan and I sign on the loan and the investor doesn't, then the tax law says that they can only get up to how much they put in. So,
Gotcha.
So the tax the loss on the K1 is going to be $3.5 million. So, which is still, so it's one time, or it could be 3 times.
Right.
So what happens is, because it's a fund, it's kind of an average of that. So, which changes for us on. So it's between 1% to 1.3 times, or 1 time to 1.3 times. But as we bring in more money, and then we're always, it's like we're closing deals, we're bringing in money, we're closing deals. So it's a moving target, but it's an average of the recourse and the non-recourse deals.
Which is a huge deal if you have that big capital gains build that you're looking at, and you can just pay the tax and be done with it. Yeah, you're not rolling it. You're kind of resetting it.
Right.
Yeah.
Right. So worst case scenario, if they have a 750 gain, all they'd have to do is put in 750, and they'd have at least a 750 loss.
Wow. And then so
it would wipe all that out.
Then
so if they were planning on paying, 300,000 of that in taxes, that'd be so really their buy-in is only 450 to get boom.
Yeah.
Wow.
That's
well,
crazy.
and then so if there's 750,000 going in, how does that, because eventually they probably want that money back too. So how do you guys work with investors on returning?
So a typical, let's use that $10 million, buy it. First year expectations, our cap rate's low. It's a good park. It's a good location. Yeah. But we got to go work it.
Yep.
We got to solve those problems that we talked about, right? So first year's expectation should be about a 5%, 5% returns. First 12 months, you're going to make 5%. After that, it should go up about 2 to 3% per year.
Yeah.
Once we get to, that 13, 14%, the value of the property is now, instead of 10 million, it's all based on cap rate, 10 million, it's now worth 15 million. So we're going to go harvest that property.
Yeah.
And get that new loan, boom. And when we get that new loan, 100% of the cash from that loan goes to the investor. And we have a very unique structure, the way we do our investment too. Yeah. Most we have like a no fee type deal. Most real estate syndicators, they charge acquisition fee, disposition fee, asset management.
I've heard some of those REITs. It's basically like that all that wrapped up is like 20%. I mean, that's how much the management companies make.
It's fee heavy. The brokers love it because that's how a lot of transactions.
Right. Yeah.
We don't do that.
Right.
So we put a big chunk of our own money in the deal.
Yeah.
And and our money's not in the deal to make 5%. We're there to make 15% IRRs.
Right.
At a minimum. We're trying to beat that.
Yeah.
But what we do is we do a 5% pref, and we do a 50-50 split. But here's a trick on that. What we do is we send 100% of the cash flow on top of the 5% pref to the investor.
Okay.
Until they've received all their money back, all their original investment back, plus 5% per year.
Wow. Okay.
And then that's when the split happens. So
Gotcha.
the 50-50 split maybe it doesn't even happen until year 5.
Okay. Yeah.
You know, we actually have an in-house loan guy. All he does is loans, acquisition, refi. And we were in the office till 6:30 last night looking at which parks we're refinancing first quarter. We've got 3 properties from 2018 that we bought that we're going to be refinancing first quarter of next year, that we're going to be getting 100% of cash out.
Wow. Yeah.
So, the goal is that we'll underwrite it for a 5-year refi,
right,
on a 30-year projection. But the goal is to, the incentive, because we don't get paid up front a fee.
Right.
We don't get paid a fee if we sell it.
Right.
We get paid when we get 100% of the money back to the investors.
Right.
Plus they make
their 5%.
Yeah.
Which is huge. Yeah.
So pretty good, I guess, comfort with the investors to know, like, hey, these guys aren't gonna make their money and then
leave me
not bounce, but like, underperform. These guys make their money when I'm happy.
The incentives are in the right place. I mean, if you really think about the whole world of investing is so it's so fee based, and all the motives, it's because otherwise, a lot of the real estate syndicators, they do a higher pref, right? That they'll do, but they'll charge in the mobile home space. There's less deals out there. It's tough to find good deals.
Sure.
So it's not a 1% fee. It's a 2 to 4% acquisition fee. Mm-hmm. So that's a big capital event for them.
Yeah.
And then it's a 70-30 split on top of a 7 pref. So for that 30%, that's heavy lifting they got to do. Right. When all they have to do, otherwise they'll just put lipstick on it, raise the rents, and then sell it. Boom, capital event. And then on to the next one.
Right.
And the other thing is, on our IRRs, our performers are based off of a refinance. They're not based off of a sale. If we used a sale scenario, it'd be easy. Yeah, it'd be easy to hit the numbers. So
yeah, gotcha. Well, that's really.
But I mean, the tax thing is
kind of icing on the cake. It's kind of like, oh, this is delicious cake, and wow, the icing is frosting.
It's a huge
Lemon Vest.
Yeah. It's a huge game changer. I mean, I had a broker from one of the big top firms, a mobile home, an apartment broker. Right. I mean, I've got brokers, all sorts of real estate brokers plugging into this because it really helps them out.
Yeah. So that has to have been just rocket fuel for your business in the last year and a half.
Well, and probably a good thing to bring up is this strategy obviously has been working for a long time, and the mobile home park is a good asset class, but the tax bang that you guys are really able to offer, that is limited, correct?
Yeah. So it goes until 2023, and then it reduces down from on how much of how much you can take as bonus until 2026.
Gotcha.
And then it goes away.
Yeah.
And of course, we don't know what's going to happen with the current administration. Sure. So who knows if there'll be some sort of
you gotta get in while the getting is good as far as that's concerned. Yeah.
So it's we want to pick up as much bonus depreciation as we can.
Absolutely.
This year, next year.
Yeah. So so what is your kind of goal on the fund? Is your plan to hold these parks literally at infinitum? Is that the plan?
Yeah. This specific fund is going to own about 33, maybe 35 properties. It closes. We stop taking money on this specific fund at the end of the year.
Okay.
We will be starting a new fund next year.
Mm-hmm.
Probably mid-January we'll get it opened up.
Yeah.
But the goal is to stabilize those properties, continue to improve on them, and be able to refinance out and get the investors their money out, and just keep improving on those assets. I mean, they're lifetime assets.
Yeah.
You want to
No, I mean, for those listeners that don't really know why they're such a big deal. I mean, the mobile home space. Well, we had this conversation.
One of the things that we didn't talk about was supply and demand.
Right, supply and demand. Yeah.
I mean, everything. When we were talking about. At the last episode we were talking about school and all these other things. It's like if people just studied, if they want to get into business and they just studied supply and demand, right?
Yeah.
Mm-hmm. So the basics of mobile home parks and even RV parks will surprise you.
Yeah.
But you have supply and demand in your favor just tremendously. It's not, you can't even compare it with anything else because the cost to build a mobile home park if you go out and buy one piece of land here in Sacramento, just the permits and fees, not counting the land, the construction, all these other things, might cost you like $70,000 before you do anything.
Right.
So if we can go out and buy a park for $50,000 a space,
right,
we're already ahead of the game.
Right.
But
Absolutely.
you can't. They're irreplaceable properties.
Right.
And it's not like the government's ever done a good job doing affordable housing.
Right.
But they keep getting their hands in the mix.
Yeah.
So the whole system is kind of messed up. So the last like great housing option for affordable housing really is mobile home parks.
Yeah. Well, I think you're talking. I think you said there's been one mobile home park approved in like the last several years or something like that. Something crazy.
Yeah, I mean,
it was. Yeah, it was really tiny and minuscule. Going back to the supply demand.
Yeah, so you figure more mobile home parks are eliminated every year.
Okay.
Same thing with RV parks because the land value.
Gotcha.
So it's.
Which is funny because now you're looking at it and you're like, no, I'm seeing that actually that land is actually more valuable as a mobile home park than it is something else because of what it can do over the long
because
term.
a lot of times they're not good operators. They're not running it right. They're not putting money back into it.
Okay.
They're not being good.
Sure.
They're not good custodians.
Okay. Yeah. And that's and you bring that wealth of knowledge to that level and go and turn something that's kind of maybe you're finding like a diamond in the rough or putting turning a pig into not a pig or something like that. Whatever analogy you want to use.
Yeah, we're cleaning the parks up. We're making them clean, safe, friendly communities.
Good place for people to live.
Yeah.
Yeah. Well, so if this is a limited tax strategy, what type of events should like our listeners kind of keep in mind of like, hey, if I have these types of things coming up in the next couple of years, I should probably think about maybe entertaining this idea. Like, what should they be thinking about in the next couple of years?
Well, I think that there's if you're thinking about doing a 1031 exchange, but you're just not satisfied with what you have out there, this is an option for you. If you have a lot of passive income, K1 passive income, then this is a fantastic option for you.
Right.
On the other side of that, if you don't have passive income, you need to get your butt in gear and start investing every single year so that you have the whole goal is to have your passive income exceed your regular income.
Right. Absolutely.
Right. That's goes back to buying time. If you want to buy time, that's how you do it.
Right.
Yeah. So it's really a good strategy for anyone. And if you can invest in stuff that brings you cash flow,
right,
but all that cash flow is protected because even if, let's say you take the bonus depreciation, you get it just sits in your little bank. It doesn't go anywhere.
Yeah.
So it's still going to protect that cash flow every single year. You'll just eat into it every single year. Boom, boom, boom. But you'll have more of that money to reinvest, plug it into more investments.
Right.
And that's how wealth is built.
Yeah. Yep.
It's, you keep compounding it and compounding it.
Yeah. Yeah. Very cool.
And I'm sure that, I'm sure since this is a tax strategy, CPAs need to be involved in, so for most, for most guys who are kind of exiting out of their business, they're like, hey, my CPA does everything for me. Like I try not to, I hire people to know the tax code to do that stuff for me. And I'm sure you guys have some sort of synergy with, so how does that work if someone's like, hey, this sounds interesting, but really I don't want to talk to him. I want my CPA to talk to him. How does that relationship work?
We get on the phone with our CPAs, with their CPAs, that it's, you got to get them, to review the information and
do the due diligence and get comfortable with it.
Because a lot of times, we have a lot of people that they plugged into the fund at the beginning of the year to figure out their spot,
right,
to lock it in, because we did a fund this year. It was only up to 100 investors. That was it. That's all we allowed. We actually raised over $55 million. Phenomenal. Right. The goal was 30 million. We raised over 55. Yeah. So, what they did was they made sure they got their spot, right? Because our minimum was 300,000, so they'd plug into 300. Now I've got my spot, but I left it open because we all have refinances, we all have
things going on.
We wanted to be able to plug into one vehicle that could invest into all these different mobile home park deals, so that we could be properly diversified across the country on mobile home and RV parks. So, but they worked with their CPA to know, because a lot of them were brokers, so they were, they wanted to see what their income was going to be, and so towards the end of the year, they're like, okay, I'm going to invest 500,000 more or 300,000 or more or whatever, based on how things went that year. Sure. So it was kind of a neat way to do it.
A little backwards math. Like I want my spot, but I don't know how much I need to actually offset.
Yeah.
Right. Yeah.
That's awesome.
Yeah, very cool. So can we just dive into just the RV parks, real quickly? How'd you get in that business, and how's it similar to the mobile home park business?
I bought. We used to buy like, and we still do, like more long-term RV parks that were ran like mobile home parks.
Gotcha.
Where people lived in the RV, but and we have some even here in Sacramento. But again, it's kind of the mobile home model.
Yeah.
So in 2017, we bought a super high-end RV park in Borrego Springs. This place is called The Springs. It's it came with a mobile home park. It was a $27 million deal.
Yeah.
Largest deal I did. I was scared, doing
right.
it.
Yeah.
As you're writing the check, at the time it was the biggest raise that I did.
Yeah.
Of course, I put a chunk of my own cash into it.
Right.
And it's the mobile home park's a 400 space park with about 70, 80 vacancies that we need to fill. And then the RV park's 160 spaces, but everything is so high end. I just came back from there. I was there with my family on Thanksgiving. The broker that sold it to us had his 60th birthday party there.
Wow. Yeah. Super.
I mean, it's a nice place.
Yeah.
He had 40 RVs come in November. And he threw like a 4-day party. It's got 2 golf courses on it.
Oh wow, okay.
This property, if you like to RV and you like to golf, and you like the desert and off road and all that stuff, it's amazing. So, the guy that sold it to me recently passed away. Bill Wright, phenomenal guy. When I flew down to check out this property, I was actually flying in our small airplane in Utah. I got a call from the broker because a year prior, so in 2016, it was for sale for $35 million.
Yeah.
And they were finishing the marketing and building up the RV side. Well, the RV side, the numbers didn't look good. So the broker calls me, a good friend of mine. He says, "Hey, just had lunch with the seller. I'm here in my RV with my wife." And the seller had like a little estate right adjoining,
property?
Yeah,
okay,
next to the property. So he said, "Hey, just had lunch, talked him into selling for this thing for $27 million. How quickly can you be here?"
Yeah.
So, I think I was eating like chicken wings or something in this weird place in like Price, Utah, or some weird place. So, so we hopped in the plane, flew a couple hours down, and landed there, and stayed the night. The whole place was booked because they had this weird bloom. I don't know if you guys are. Super bloom.
Super bloom. Yeah.
So
when it rained in the desert.
We're from Auburn and Sacramento, so when there's flowers, when it rains, we're like, oh, those are flowers. Some of those are weeds.
Yes. Right. Yeah.
But if you're from San Diego or LA, you're like super bloom, and then what you do is you put your Indiana Jones outfit on, and you have a giant camera, and you walk around in the desert really close up, and you do. It's really
it is a big event. My mom's gone to it before.
Yeah, I went out there. I'm taking pictures of the people taking pictures.
Yeah. You're like,
I've never seen anything like that.
Like, wow, it's so colorful. You're like, yeah, they both are.
Yeah,
both flowers are colorful.
Yeah.
So, the RV park, I tried to like parse it off. Like I didn't want. It was too much work. It's like running a hotel.
Right.
I didn't understand the business. We've done phenomenal with this park. It's killed it, because if you think about an RV park, instead of spending $50,000 on buying a home, bringing a home in, setting it up,
right,
spend another and then trying to sell that, you could spend $10,000 on marketing and fill up 100 RV spaces.
Gotcha. Yeah.
So it's a marketing play, but you got it. It's more of running, a hotel rather than an apartment complex is more similar to the mobile home park. So you have to have its service is so important,
right?
All these things are under a microscope.
So you had to kind of ramp up a team there to kind of take care of that. That wasn't kind of in your wheelhouse at the time,
right? Yeah. And we learned a lot from the team there.
Okay.
But I like the brand, and the other thing is it was fun.
Yeah.
I mean, there's mobile home parks that we buy; they're great investments, but I'm not going to go there every year. I'm not going to spend Thanksgiving there.
Right.
This place is so much fun. So we put together the Boa Vida RV Parks and Resorts brand. We've got a beautiful website.
Yeah.
We've got properties in Las Cruces, New Mexico. We've got a beautiful park up in Trinidad, and in the redwood forest there. We bought the Willits KOA, so we'll be converting that to the Boa Vida brand.
Nice.
We're just having a blast, and we're making money.
Yeah.
We're buying the RV parks for better cap rates because they're tricky to run.
Yeah.
Instead of paying a 5 cap, we're paying a 9 cap.
Okay.
So the cash flow day one is double digits with good leverage.
Wow. Yeah.
So, but they're more cyclical. There is more risk, and that's the beauty of the fund. The goal of the fund was to be 80% mobile home, 20% RV, and we're more like 90-10.
Right.
So hopefully next year we'll be more 80-20.
Yeah.
But if you look at the economics, that go back to supply and demand.
Right.
More of those RV parks are being turned into mobile home parks because they never leave that space.
Right. Yeah.
So all the people traveling on the I-10 from Jacksonville to California,
right?
A lot of these parks they're now where people are living, and then a lot of them are getting dilapidated. So there's every single year there's less RV parks in the country.
Gotcha.
Yet we've had record sales. I mean, the last 10 years in RVs has been record sales.
Right.
And then so it's not just the seniors and the baby boomers. You have millennials getting into it because they think it's cool.
Yeah.
So
and it's a cheaper way, cost of living wise, to go live somewhere. The tiny house and that whole
adventure vans.
Yeah, that whole thing. Yeah, that's very cool. Yeah. Again, it's amazing how it always kind of does go back to the supply demand equation, and you're basically filling a need that is going away.
Yeah. It's and hopefully we'll build that RV surf camp.
Yeah, no, that's the next thing. We're gonna talk about that.
I'm gonna go get some more credit cards. I'm gonna max them out to invest in that.
Yep. Yeah.
I tried my hand at surfing. I got decent, but now I don't live next to the ocean. So
yeah, so we need one in.
Yeah.
In
we're gonna
Rockland.
bring the ocean to Sacramento.
Yeah, bring the ocean to me. So
yeah, start surfing. No, that's very exciting stuff. Real quick, I want to talk about you were on the Mark Haney show and you were talking about your uncomfortable giving. Can we kind of dive into that, because that's a huge thing for us here too? Is we do charitable planning and things like that for our clients, but it should be part of your business model. When you're blessed and get taken care of, that you have to pass that on.
Yeah, that was a fun episode, and Greg Van Stavern over there, he's invited me on the show a couple of times. So I've been very involved with Fellowship of Christian Athletes.
Okay.
Actually, I've got a meeting at 4:30 today with one of our FCA guys that handles the kind of the Natomas area, and Otis Amy used to play for the 49ers. He's handling the whole Northern California area, and we've been involved for several years now, and supporting them and helping them grow that ministry, and that's been a lot of fun.
Yeah.
I've been involved with Allegiant Giving Center a little bit.
Okay.
I always call it Keaton
Raphael.
Keaton,
yeah.
But now it's childcancer.org. Anyway, that's Reed Baumgarten, unbelievable guy.
Right.
They're doing a really great job there, so we're very supportive of him. The uncomfortable giving piece it's really about how can I challenge myself? If a poor person gives a little, I mean, that's a lot more than me giving a lot, right? So, how do we actually make ourselves give so much that it's uncomfortable?
Right. Yeah.
And I think that I probably take the easy route. Like I give, more money than I do time.
Okay. Right.
And that's probably my biggest challenge.
Yeah.
So I'm always kind of trying to push. I actually have I don't want to say budget, but I increase my budget every year quite a bit.
Right.
I would say it was more like a goal. It's a giving goal every single year that I'm trying to push out.
Right.
And I would say the challenge of that is that because I'm very involved with our church, the Crossing Church in Natomas. Okay. And the challenge is to make sure that as an entrepreneur, you want to make sure that money's getting to work, right?
Right.
So that's kind of like what my meeting later on today.
Yeah.
I want to meet with the guy because I want to give more money.
Yeah.
But
I want to make sure
without me telling him I want to give him more money, I'm like, okay, what's the plan?
Right.
What's a plan?
Yeah.
And I think that you have to have. I think maybe that's where the faith stuff comes in. You just have to say, well, it's not my money anyway. Just give it and let them do it.
Right.
And I think that's a lot easier for me to do. Maybe with my church, and maybe with some of these other local charities, fantastic charities. I mean, so many good charities.
There's a lot of good right here.
In Sacramento's, just especially with sex trafficking and stuff like that. We try to do a lot for that. But I think that's the challenge is as an entrepreneur, almost, some things you want to be more involved in, and some things just give the money, don't,
Yeah. Kind of let God kind of take care of it.
Yeah.
I always kind of joke that when I'll give a quick analogy, quick story. One time I was buying a cell phone for our missionary friends in Brazil, and we were leaving the next day. They want, iPhones are super expensive down there because of the big tariff. Anyways, I told the guy buying it from me, I was buying off a guy for Craigslist. I'm in the parking lot of a Rayleigh's, and I was like, hey, does this thing work? I don't have time to check it out. Does it work? He's like, yes, it does. I'm like, well, that's good. Because if it doesn't, you're stealing God's money, not my money. So you're going to have to deal with that. And he was like, oh, no, man, it works good. It works good. I was like, okay, I'll trust you. I grabbed the phone, gave him his money and it left. So it was just one of those, you kind of just got to trust that, God's going to take care of his stuff and be fine. So I'm cool. I'm glad we got to bring that part up. That's awesome. I like that kind of stuff.
I guess now we can jump into the speed round.
Yeah.
And, well, actually, first, where can people? So we got the Bovita RV parks. Where else can people find more information about you guys, either from the trailer park or as an investor?
Go to the bovitagroup.com and you'll find lots of great information. You'll find our contact information, and you can reach out to us on there.
Awesome.
Perfect.
And, for those of you that didn't see it, catch it on the last episode, we did talk about what does the Bovita mean as the good life. And I love that story. That's very neat. And it's very, very fitting that's how you name your company. It's very, very cool. So for all of us here, thank you so much for taking the time. We're going to dive into speed round here real quick and answer questions.
Speaking of your website, I did notice on your website, you are listed as Trailblazer on the website. Is there, story behind that, or how did you claim the title of Trailblazer?
Well, we're not huge fans of
CEO, CFO,
yes, chairman and some chairman and CEO. I mean, all right, that doesn't sound great. But so we just came up with fun names, and I think that Eric Resnick probably came up with that for me, and I think because I set the pace.
Okay.
I set the pace, and I set a very fast pace.
Yeah.
And if you come into our office and check things out, I mean, you'll be like, things are cooking there.
Yeah.
We're moving. Everyone's pumped. Everyone's fired up. Everyone's having a good time. And but that culture and that pace is set by me, and I think that's why he came up with the Trailblazer.
I love it. Perfect. So in your mobile home park, some fantasy amenity you could put in. I mean, like laser tag, arena, virtual. What is it?
It's the man-made waves.
I was going to say, we already talked about it.
Yeah, there we go. Look for that. We're going to do that.
We're going to do it in the next 5 years.
Then I'm going to tell my wife, good news, we're moving into a mobile home park.
It's going to have a surf wave.
Park.
Warren can learn how to surf finally.
Yes.
At a young age.
Finally. Gosh. Been working on it for like a year and a half now.
Come on. Jeez. Get your stuff together, kid.
All right. And then one location, if you could pick one location for, hey, this is my most ideal mobile home park.
They got that park in Malibu. I mean, the home sell for, $1 million, $2 million bucks. It's like crazy. So
is that on the docket for the investment for 2020? So you're going to try and do a big deal.
That's what I'm maxing out my credit cards for.
The beauty about mobile home parks is that people need affordable housing everywhere.
Sure.
So as an investment, the first deal we did that we made, $1 million on was in Oroville. It was a suburb of Oroville.
Yeah.
So that's, you don't have to worry that it's got to be a good location, but
people need a place to live. Yeah. Especially on fixed incomes and that sort of thing. Yeah, that's a huge deal. Okay. Charity you're currently trying to draw some attention to. So what is the charity you guys are kind of focused on? You talked about
Fellowship of Christian Athletes.
Any other ones that you're involved in?
Just the other ones that we named, but probably my main focus right now is FCA.
Perfect.
In our church.
Stanford wrestlers and tennis. Awesome. So we're gonna kind of end the episode there. Eli, thank you so much for being here. We really appreciate it. And kind of tell us about Bovita and your story and the first episode, and the second one, kind of the math behind it and how it works. And if you need more information, please go check out the bovitagroup.com. You can get all the information there. We do want to close this out with another big disclaimer, because we did talk about some investment strategies here. Kingsview and us are not involved in any of that. So if you want to call us, we can get you in a hold of Eli, but we're not affiliated with that in any sort of way. So nothing said here should be taken as tax, legal, or financial advice. Please contact your advisors, CPAs, attorneys. Go do all your due diligence before you do anything. But again, Eli, thanks for being here. We appreciate
and
it.
if you don't have, counsel on that level, by all means, give us a call. We can point you in the right direction, because we do think it's very important that you get good advice before you head into these types of strategies.
Absolutely.
So
also check us out on wealthpreservationpodcast.com, Apple Podcasts, YouTube, Spotify, all the normal places that you can get great podcasts and videos. Thanks, everybody. Have a great day.
thank you. Thanks.